Let's talk about whether or not deflation is the cause for worry right now. That is certainly not the consensus view, especially as everyone looks towards that big CPI print later on this morning.
Right. At least in the short term, it's certainly not the worry. I would say, if anything, the headlines that I'm reading from the strategist or just the titles are more, is inflation really transitory? Because it doesn't seem to be. I think one of the things that we need to be careful about as portfolio managers is using confirmation bias. And confirmation bias is where you seek something out that supports your theory. So where, deflation supports the really, really high-tech, high-growth stocks. And that might be a little bit of confirmation bias leaking into that perspective. That's really human nature. So I do the same thing. For my portfolio that's really dividend-oriented, that's more hard asset-oriented, that's value-leaning, I probably skew on the other side of that and think like, oh no, maybe we've got inflation coming. Maybe that's creeping up. And you need to be careful, or I need to be careful to listen very clearly to Kathy and say, is she more right than I am? Am I more right that this isn't deflationary, that it's transitory, and that it's not that transitory and inflation may persist? Who knows where it nets out? I think the reality is it's the level of inflation that we're more worried about. I actually think there will be inflation. I just don't think it's going to be runaway. I think we're going to get back to a kind of normal pace of life, of the economy. And that would argue for some version of inflation. So
Jenny, I mean, you are, and we know very well that you are a dividend-oriented, income-oriented investor. So that means that inflation has to be front and center in your mind. Is this an environment right now where those dividend-type paying stocks are the most attractive option for you, given what your worries are about inflation?
Well, what's funny is it's actually not front and center in my mind, like not at all. And the reason for that is that when you have the 10-year Treasury persistently at 1.3%, right, and bond yields just so low that they basically give you no attractive investment opportunity, then you get to actually just invest and look at the stocks. If the 10-year Treasury were at 3.5%, 4%, 5%, at that point it starts to become competitive for dividend stocks. But we're nowhere near there, nor do I think we're going anywhere near there. So no, that's not what I'm looking at. What I'm looking at are things like, what do I expect earnings growth to be? What do I expect the economy to look like? Will people shop more in brick and mortar stores this year versus online? Will we be in a less digital world this year, which we are, than we were last year? So those are the things that are really driving my investment decisions
Okay, so those corporate fundamentals matter, Jenny. Then if those corporate fundamentals are the ones that you're looking at right now, is there any part of the market that's attractive, given the fact that, yes, we had a 5-day losing streak, but we're still about less than 2% away from record highs in the overall market?
Well, it's so funny because preparing to be on this morning, I was thinking what's attractive to me. And then the earlier segment just totally supported where I was going anyway, which is REITs, real estate investment trusts. There's a lot of attractive opportunity out there. Energy is down about 10% over the last couple months. There's a lot of attractiveness in energy. And actually in healthcare too. I think there have been some concerns that maybe there would be price controls. And a lot of the healthcare stocks have traded down between 5 and 7%. So if you want me to get granular, I can throw out stocks if you want me to.
Absolutely, because I would love, Jenny, I'd love to hear. I'd love to hear what the ideas are, because I mean, healthcare we know has been so front and center with the COVID pandemic, but it's not necessarily just COVID-related stocks. Not Moderna, not Pfizer that are on the top of your list.
Right. So, for example, we invest in AbbVie and Bristol Myers and Amgen and Glaxo. We also invest in Pfizer. These guys are all down 5 to 8% over the last month. Like, if you've been waiting for an opportunity, if the market were down 5 to 8%, you'd say, great, buying opportunity. Meanwhile, they're trading collectively at under 13 times earnings. You look out to 2022's earnings growth, it's all mid to high single digit. It's pretty positive. And as we return to normal, as people, and I know your segment earlier was talking about the segment before that was talking about hospitals being full, people can't get normal things done. That's not going to persist forever. So as normalcy returns, as we go to the hospital for normal vaccines, for normal procedures, for normal everything, and that's happening. Like, we can't pretend it's Armageddon, it's not. There's pockets where it is, but for the most part, it's not. So you're going to go back and you're going to get your Botox and you're going to get your psoriatic arthritis drugs and you're going to get your vaccines like you did normally. And when that happens, I think these are really, really undervalued. So that's in the healthcare space. In the energy space, I was taking a peek at my portfolio too, and you've got the pipeline companies like Enterprise Products and Kinder Morgan. These are trading. Enterprise is trading at about 13 times earnings. They have a Enterprise has a 8% yield. Kinder Morgan has a 7% dividend yield. The sector overall is beaten up over the last month. Meanwhile, oil prices have really sustained around 70 very, very solidly.
Sure.
So like there are good things you can do there. On the REIT side, we own SL Green, which is a large office building owner in New York City. That's compelling. We can't pretend people aren't eventually going back to the office. And when you have an 8-year average lease term, you've got a long runway to let people return. Or National Retail Properties, which is a triple net lease owner of big box stores, trading with an almost 5% dividend yield. So there's a lot to do out there. There's a lot, when you think the market's frothy or overvalued, there are a lot of places where you can find value or find little mini corrections that have already happened.